If you're a seller in Calgary right now, you need to pay very close attention to what I'm about to tell you. The market has shifted dramatically in September, and the window of opportunity you had just a few months ago, it's closing fast. And if you're a buyer thinking prices are going to crash further, you might actually be making the mistake of a lifetime. The data I am seeing tells a very specific story about where this market is headed, and what you do in the next 90 days could mean the difference between capitalizing on this opportunity or watching it slip away. Before we dive into September's numbers, we need to talk about what's happening in the broader Canadian economy. Now, the Bank of Canada cut rates again in September, bringing the policy rate down to 2.5% and the best variable rate down to 3.93% according to industry tracking. But here's the reality. It barely moved the needle on affordability nationally. However, combined with Alberta's already superior affordability and stronger job market, we're in a much better position than other provinces. The next policy rate announcement is on October 29th, with just one more for the year after that on December 10th. Markets are pricing in maybe one more rate cut this cycle. Ben Rabideau, though, disagrees, and here's why. Canada's debt burden is crushing. We rank third globally for household debt relative to GDP, 40 percentage points above the G20 average. The household debt service ratio is 14.4%, meaning Canadians are spending nearly 15% of their disposable income just servicing debt. The Bank of Canada will need to cut rates below 2%, much lower than markets are currently pricing. Here's what that means for Alberta specifically. Mortgage rates typically run 1 to 1.5% above the Bank of Canada's policy rate. If rates go below 2%, we're looking at mortgage rates in the high 2s or low 3s, combined with Alberta's already better affordability and strong population growth. That's going to support our real estate market even as other provinces struggle. Now let's talk about population dynamics and why they matter differently for Alberta. Nationally, the non-permanent resident cohort is declining. International students and temporary foreign workers who saw their third consecutive quarterly outflow. There are now just over 3 million non-permanent residents in Canada, and the federal government has committed to getting that number down to 5% of the population within roughly 2 years. This group fueled the massive spike in rents coming out of the pandemic, and as this population shrinks, rental demand is going to soften significantly. But here's the crucial part. Permanent residence numbers will continue to grow at a healthy pace. These are future homeowners, and critically for Alberta, they're choosing to move here. So while we'll see some softness in our rental market, and the analysis shows that Alberta metros appear cyclically overbuilt, particularly Calgary and particularly rentals, the resale market is in a very different position. We have permanent residents coming in, we have interprovincial migration, and we have entrepreneurs and high income earners leaving Ontario and B.C, especially now with that auto sector collapse looming in Ontario. The expectation is short-term softness in rentals, but the fundamentals for ownership real estate remain very strong. There are very clear signs of a pent-up demand building. Sales on a per capita basis have been below average for 3 years now and have more than made up for the excess of the post-COVID demand surge. One more national data point, the Conference Board's Consumers Confidence Index sits at 60 versus a long-term average of 100. While confidence is low nationally, affordability is back to where we were in Q4 2021, and home sales then were 46% higher than now. It's confidence holding the market back nationally, but Alberta's fundamentals give us more reason for confidence than Ontario or BC, especially now. All right, now that you understand why Alberta is positioned so differently from the rest of Canada, let's dig into what actually happened in Calgary in September according to the Calgary Real Estate Board's data. And I'm going to be very direct with you. Yes, we're seeing some softness, but the context here matters enormously. According to CREB, September sales came in at 1,720 units, down 14% year over year. Year to date, we're sitting at 18,199 sales, down 16% from last year. Now, nationally, Alberta is actually the only major province with home sales lower than this time last year. So yes, we are seeing weakness. Nationally, sales are up 13% off March lows and nearly 30% in Ontario. While Alberta's recovery has been slower, it's because we didn't have the same crash they did. Our market stayed relatively stronger throughout, so we have less of a bounce back. We've barely even dipped. We're still kind of in that path. So let's break down CREB's data by property type. Detached sales were 859 units, down 9% from last year. Year to date, detached sales were down just under 10% at 8,914 units. Apartments got hit hardest, down 20% in September to just 401 sales. Year-to-date apartment sales are down a massive 29% to 4,434 units. This is the softness we've been warning about. We overbuilt rentals and condos, and we're seeing the impact. Semi-detached fell 14% to 156 sales, while row houses dropped 19% to 304 sales. Here's what's happening. Buyers have more options now, so they're being selective. But remember, we still have people moving here from other provinces, and with Ontario's auto sector imploding, I expect more workers to look at Alberta as their next destination. These people need homes. The question is timing and price point. CREB reports that new listings rose 2.6% year over year to 3,782 units. September year to date, we've seen 34,010 new listings, up nearly 12% from last year. Now, here's what's interesting in CREB's data. Detached new listings were up 6% year over year, but apartment listings were actually down 7%. Apartment sellers are discouraged and choosing to hold rather than list into a soft market. There were reports of a surge in canceled listings over the summer nationally. Properties came on overpriced, didn't sell, and were pulled. We're seeing the same thing here in Calgary. The big question is whether that supply returns this fall, and September's data suggests some of it is coming back. But here's why I'm not overly concerned long term. While we have lots of rental supply coming, homeowner starts, condos, and single families are at financial crisis levels nationally. We're not building enough ownership product. Combined with Alberta's population growth from interprovincial migration, this suggests supply could tighten for ownership properties even as rentals struggle. Total inventory was 6,916 units, up 36.5% year over year, and 17% higher than long-term September averages. And inventory rose 3.8% from August after falling from July to August. So we saw inventory tick back up this month. Now, instead of drowning you in numbers, here's what you actually need to know. Detached inventory is up significantly year over year, and it ticked back up in September after declining the previous month. So if you're selling a detached home, there's more competition now than there was in August. Apartments, inventory is up big time year over year. And here's the kicker. New listings were actually down 7% compared to last year, which means apartments are just sitting on the market longer. That's a clear oversupply problem. Row homes and semis are seeing the biggest inventory jumps. Semi-detached inventory is up over 60% from last year. That's a massive increase in competition for sellers in that segment. I'm not going to sugarcoat this. The inventory increase in September is concerning for sellers in the short term. We're heading into the slower fall and winter months with more supply on the market. Some of those canceled listings from summer appear to be coming back, and sellers need to be realistic about pricing. But here's the long-term context that really matters. Single-family building permits are at their lowest levels in decades nationally. While we have inventory building now, we're not creating long-term competition for the resale market through new construction. The data shows very clear signs of pent-up demand building with sales on a per capita basis below average for 3 years now. The question is whether more supply returns this fall or whether sellers decide to wait until spring. This September's inventory increase suggests some of that supply is coming back, which means we could see continued pressure through the fall. Okay, so months of supply metric hit 4.02 months in September. The first time we've crossed the 4-month threshold since early 2020. We are definitely starting to tip the scales in favor of buyers, but look at CREB's breakdown by property type. Detached homes are at 3.73 months of supply, still relatively balanced. We're not in crash territory here, but we've definitely shifted from the seller's market of last year. Apartments hit 4.99 months of supply, basically 5 months of supply. This is a buyer's market territory, and this is where we overbuilt. Row homes at 3.62 months and semis at 3.96 months are both approaching that 4-month threshold. The sales to new listing ratio dropped to 45% overall, according to CREB, 45% for detached, 43% for apartments and semis, and 51% for rows. Here's my take. Apartments are oversupplied, as I said, and will continue to struggle. Row houses and semis are entering buyer's market territory, but detached homes, we're in a balanced market. And with strong interprovincial migration and a severe lack of new construction competition, I don't see this becoming a deep buyer's market. This is not a recipe for price crash in single family homes. Now, with that being said, we will see the bigger inventory gains in communities that are competing with new build properties. Now, for what everyone wants to know, what's happening with prices? The benchmark price for all residential property types fell 0.1% month over month and is down 4% year over year, sitting at $572,800 for the first time since 2022. All 4 major property types posted monthly declines. But before I break down the prices by property type, I want to share a statistic I've been tracking closely, as you know if you watch my videos, because it really tells a story of where this market is heading. In September 2025, only 6% of homes sold over list price and 12% sold at list price. So just 19% of homes are selling at or over asking. Compare that to September 2024 when 37% of homes sold at or over list price, and then go back to September 2023 and we had 51% of homes selling at or over asking. This is one of those clearest indicators of our shift into a buyer's market. We've gone from more than half of all homes selling at or over asking 2 years ago to less than 1 in 5 today. That's a dramatic shift in negotiating power from sellers to buyers. Now, let me be clear about what this means in practice. Yes, we're still seeing multiple offers happen. I just had seller clients this month who received multiple offers, but here's the difference from 2 years ago. Even in that multiple offer situation, one of the offers came in under over $10,000 under asking. 2 years ago, multiple offers meant buyers were bidding $50,000, $75,000, $100,000 over list price. Today, multiple offers don't guarantee you're going over asking. It might just mean you're getting close to your list price instead of taking a discount. So when you hear multiple offers in today's market, don't assume it's going to drive the price way up like it used to. The dynamics have completely changed, and this is critical. Just because we're in a buyer's market doesn't mean we're going to see steep price declines. What it means is the days of those crazy bidding wars where people were throwing caution to the wind are over. Buyers have time to negotiate, to do their due diligence, to be selective. But the fundamentals still matter, and that's what's going to prevent a crash. Let me break down the price data by property type because the story is a little more nuanced. Detached homes, benchmark price is $749,900, down 0.75 from August, and down just 1% year over year. But year to date, detached prices are actually still up nearly 2%. We're seeing prices stabilize, not collapse. The biggest price drops were in the Northeast District, down over 5.6% year over year, but the city center is actually up over 1% year over year, with year-to-date gains over 4%. Apartments are at $322,900, benchmark price, down 1.1% from August and down 6.4% year over year. The Northeast saw apartment prices fall over 10% year over year. This is the oversupply issue playing out exactly as predicted. Semi-detached, 684,800, down 0.35% monthly, but actually up about 1% year over year. Year to date, semis are up over 3%, the strongest price growth of any segment, according to CREB. Row homes are 437,100, down 0.57% month over month, and down 4.8% year over year. Here's why I remain confident in Calgary's market for ownership properties. The analysis shows they're quite confident predicting the home sales likely bottomed in Q1 for this cycle and will improve modestly in 2026, even as the rental market softens, and why they expect single-family resale supply will begin to tighten next year, even as the rental market faces a wave of new completions. So keep in mind, that's nationally. This is exactly what I've been telling you. Apartments will struggle. We overbuilt them, but single-family homes, we're not building enough to meet demand. We have strong population growth from other provinces, and the fundamentals remain solid. CREB's data shows that from peak to trough, we're down 19% in nominal terms and 30% in real terms. But that peak was unsustainable, driven by panic buying and historically low rates. We're now at prices that make sense given fundamentals. And with Alberta's competitive advantage, I don't see a significant downside from here for quality ownership properties. The shift to a buyer's market, evidenced by that drop from 51% to 19% selling at or over asking, means buyers have real negotiating power. It means sellers need to be realistic about pricing and understand that even if you get multiple offers, you might still be negotiating, but it doesn't mean we're heading for a crash. It means we're normalizing after an overheated period, and that's actually healthy for the long-term sustainability of our market. A few other critical data points from CREB. Days on market jumped to 42 days in September, up from 28 days last year. Yes, homes are sitting longer, but this is normalizing again from that overheated market. Sales to list price ratio dropped to 97.71%, down from 99.16% last year. Buyers are negotiating, but sellers are still getting close to asking. So what's the bottom line? Sellers, price it right and present it well, or expect it to sit. Multiple offers don't mean what they used to, but don't panic. Alberta's fundamentals are solid. Buyers, you have negotiating power, especially for apartments and townhouses. Use it. But if you're waiting for a 20% crash in quality detached homes, you're going to be disappointed. The crash isn't coming, I don't think. Investors, stay away from apartment rentals for the next 18 to 24 months. But long term, I remain very bullish on Alberta real estate for all of the reasons we've covered today. Short-term volatility, absolutely. Long-term fundamentals, rock solid. Alberta is in a fundamentally different position than the rest of Canada, and that matters. That's it for September's update. I hope you found value in this video. I'm always here if you have any questions. Thanks for watching, and I'll see you soon.